Welcome back, guys. This is Karan Singh from Optimal Loans, and today I will be showing you what's behind those curtains. Don't close your eyes, not my curtains, but the banker's curtains. This video will help you understand how the mortgage industry works and why lenders ask so many darn questions. Okay, for example, when you go to your loan officer or your lender nearby, you give them your application. Then your application goes into underwriting, which is a fancy way of saying someone's looking at your paperwork. But what they're really looking for is, can they turn around and sell your mortgage? Now you're probably thinking, why do they want to sell my mortgage? And who's going to buy my mortgage? Well, let's answer the first question. When lenders sell your mortgage, they get it off their books, hence it's less risky. Second, when they sell it, somebody's buying it, so they're getting more moolah, more capital, so they can turn around and do more loans. Now, to answer the second question, let's peek behind those curtains.
The market is made up of three very important parts: the primary market, the secondary market, and the MBS market. The primary market is the front-facing market, which consists of banks, mortgage brokers, and consumers. The consumer has a need to buy a home, and the bank fulfills that need by providing a mortgage. This is just one part of the market. Next, you have the secondary market, which consists of two entities called Fannie Mae and Freddie Mac. These are both known as GSEs, government-sponsored enterprises, but also privately owned. Yes, guys, welcome to the beautiful world of capitalism. The secondary market was created during the Great Depression to provide more liquidity in the mortgage industry throughout the country. And they have been doing this by buying mortgages from banks, hence answering our question. Now, another question may have come to your mind. Why do they buy the loans, and what benefit is it to them? That's where comes the third segment of the market, which is called the MBS market, known as mortgage-backed securities. When your mortgage comes to this stage of the cycle, it is no longer called a mortgage. It becomes a note yielding a certain rate for X number of years, and it is sold to investors and folks on the Wall Street. This is how the secondary market earns its capital. Lastly, I would like to mention rating agencies that work amidst the secondary and MBS market. Rating agencies rate these bonds and provide guidance to investors on their investment in these mortgage securities. The riskier the bond, the worse the rating. Now, let's look at the market as a whole. A need arises on the primary market, a loan gets created, then it is bought by the secondary market. The secondary market then creates mortgage pools rated by rating agencies and sells them in the form of bonds known as mortgage-backed securities. And this is how capital circulates freely throughout the whole market. You get the point now. If any one of these submarkets doesn't fulfill its job or screws up, it can disrupt the flow of capital that allows this market to run. So when your loan officer tells you that they have to pull your credit or asks you 99 questions about your financial situation, it is simply to ensure the workability of this system and to make sure all parties are safe financially, including yourself.
Thank you for watching this video today, guys. I hope all the information was very insightful to you. Please don't forget to share, like, and comment. I shall be back very soon with more videos for you. Until next time.